They told you silver would never break $80. They said the fundamentals didn't support it. They claimed the industrial demand was overblown and the supply deficit was temporary. Well, silver just shattered through $80 per ounce for the first time in history, and the financial establishment is scrambling to explain what they said was impossible. But what you're witnessing isn't just a price breakout. What you're witnessing is the setup for something far more dangerous to the existing order, something that could send silver prices into the stratosphere in a matter of days, not months. It's called a gamma squeeze, and if you don't understand what's building right now in the options market, you're about to miss the most explosive phase of this rally. The banks want you to believe this is just another speculative bubble. They want you to think that $80 silver is the top, that smart money is already taking profits. They are desperately hoping you'll sell your position before you realize what's actually happening beneath the surface. While everyone is focused on the spot price, while the mainstream media is calling this unsustainable, the derivatives market is setting up for a mechanical explosion that has nothing to do with sentiment and everything to do with mathematics. In this deep dive investigation, I'm going to expose the gamma bomb that's been quietly building in silver options. I'm going to walk you through the exact mechanics of how a gamma squeeze works and why the current positioning makes silver uniquely vulnerable to this phenomenon. I'm going to show you the critical strike prices that could trigger an avalanche of forced buying. And I'm going to explain why $80 isn't the peak. It's the launching pad for something the precious metals market has never seen before. This isn't speculation. This isn't wishful thinking. This is the mathematical reality of a derivatives market that's about to turn against the very institutions that created it. The gamma squeeze that's building in silver makes the GameStop saga look like a warm-up act. Because unlike a meme stock, silver has real industrial demand backing every ounce. When the squeeze hits, there's no fundamental floor to catch the shorts. There's only the brutal arithmetic of forced liquidation. To understand why silver is sitting on a gamma time bomb, you have to understand what makes this market different from every other commodity. Most people think the silver price is determined by mining supply and jewelry demand. They think it's driven by inflation fears or safe haven flows. But in reality, the silver price is increasingly controlled by a shadow market that most investors don't even know exists. It's the options market, and it's where the real power lies. Here's how it works. When you buy a call option on silver, you're not buying silver itself. You're buying the right to purchase silver at a specific price called the strike price before a specific date. The person who sells you that option, usually a market maker or a large bank, is taking the opposite bet. They're betting silver won't reach your strike price. But here's the crucial part. The option seller doesn't just sit there hoping they're right. They hedge their position by buying or selling the underlying asset, in this case silver futures or the silver ETF. This hedging creates what's called delta. Delta measures how much the option price moves when the underlying asset moves. If silver goes up $1, a call option with a delta of 0.5 will go up 50 cents. But here's where it gets interesting. Delta isn't constant. It changes as the price moves, and the rate at which delta changes is called gamma. When gamma is high, small moves in the silver price force market makers to buy or sell large amounts of silver to maintain their hedge. This is where the feedback loop begins. Right now, the silver options market is loaded with call options at strike prices that seemed impossible just months ago. There are massive open interest positions at $85, $90, and even $100. When silver was trading at $60, these strikes looked like lottery tickets. Market makers sold them for pennies, collecting premium from optimistic silver bugs who were betting on a moonshot. The market makers were happy to sell these options because the probability of silver reaching those levels seemed remote. But now silver has blown through $80, and those impossible strike prices are suddenly very possible. The market makers who sold those calls are facing a nightmare scenario. As silver approaches their strike prices, the delta on those options is exploding higher. Market makers are being forced to buy more and more silver futures to hedge their positions, and the more they buy, the higher the price goes. The higher the price goes, the more they have to buy. It's a mathematical spiral that feeds on itself. This is exactly what happened to GameStop in January 2021. Retail traders bought massive amounts of call options. Market makers had to hedge by buying the stock. The buying drove the price higher, which increased the delta on the options, which forced more buying. The stock went from $20 to over $400 in a matter of weeks. But GameStop was just a stock. Silver is a physical commodity with genuine supply constraints and massive industrial demand. The gamma exposure in silver right now is unlike anything the precious metals market has ever seen. According to options flow data, there are over 50,000 open call contracts at the $85 strike alone. Each contract represents 5,000 ounces of silver. That's 250 million ounces of silver that could be called away if those options finish in the money. To put that in perspective, that's nearly a quarter of annual global mine supply tied to a single strike price. But it gets worse for the market makers. The gamma profile is heavily skewed to the upside. There are massive call positions at $90, $95, and $100. There are relatively few put options providing a natural hedge. This means the market makers are net short gamma. When you're short gamma and the market moves against you, you're forced to chase the price higher. You become a buyer when you want to be a seller. You're trapped in a mechanical process that has nothing to do with your view of the fundamentals. The silver ETF, SLV, is at the center of this gamma storm. SLV is the most liquid way to trade silver exposure, and it's where most of the options activity is concentrated. The ETF holds over 600 million ounces of physical silver, but it's also the primary vehicle that market makers use to hedge their options positions. When they need to buy silver to hedge their call options, they often buy SLV shares, which forces the ETF to acquire more physical silver. This creates a direct link between the paper options market and the physical silver market. Unlike other commodities where futures can be cash settled, silver ETFs must be backed by real metal. When options-driven buying hits SLV, it creates real demand for physical silver. And with silver already in a structural supply deficit of over 100 million ounces annually, this additional demand pressure is like throwing gasoline on a fire. The timing of this gamma setup couldn't be worse for the shorts. Silver has broken through every major resistance level. The $49 high from 2011 is now distant support. The psychological barrier of $50 was obliterated. Even the historic highs from 1980 have been left in the dust. Each breakout has brought more call buying, more gamma exposure, and more mechanical buying pressure. What makes this gamma squeeze potential so dangerous is the liquidity profile of the silver market. Unlike the stock market, where there are millions of shares available for trading, the silver market is relatively small. The entire global silver market is worth less than the market cap of a single large tech stock. When forced buying hits a small market, the price moves become amplified. A few $100 million of options-driven buying can move the silver price by $10 or $20. The industrial users of silver are watching this setup with growing alarm. Solar panel manufacturers, electronics companies, and automotive suppliers need silver for production. They've been hoping for lower prices to reduce their input costs. Instead, they're facing the prospect of a gamma-driven price explosion that could make their products uneconomical. Some are already panic buying, trying to secure supply before the squeeze intensifies. This industrial demand creates a floor under the silver price that didn't exist during the GameStop squeeze. When GameStop collapsed from its highs, there was no fundamental reason for anyone to buy the stock at elevated prices. But silver has real end users who need the metal regardless of price. Solar manufacturers can't stop production because silver hits $100. They have to pay whatever price the market demands. The Federal Reserve's monetary policy is adding rocket fuel to this gamma powder keg. With interest rates still historically low and the dollar weakening against major currencies, precious metals have become the go-to hedge for institutional investors. But it's not just hedge funds and family offices driving this demand. Central banks around the world have been accumulating silver at unprecedented rates, treating it as a strategic reserve asset rather than just an industrial commodity. This institutional buying creates what options traders call a volatility smile. When large institutions buy silver, they often hedge their positions with option strategies. They might buy protective puts or sell covered calls. But the current positioning shows something unusual. The put-call ratio in silver options has collapsed to historic lows. This means there are far more call buyers than put buyers. The market is positioned for explosive upside moves, not downside protection. The geopolitical landscape is making this gamma setup even more precarious. Trade tensions, currency wars, and supply chain disruptions have made silver a critical national security asset. Countries are hoarding the metal to ensure their technology and defense industries have adequate supply. When governments start competing for limited resources, prices don't follow normal economic rules. They follow the laws of strategic necessity. China has been particularly aggressive in its silver accumulation strategy. Their solar panel industry alone consumes over 30% of global silver production. Chinese manufacturers have been building strategic stockpiles, knowing that any supply disruption could cripple their renewable energy ambitions. This government-sponsored buying creates a price floor that keeps rising as stockpiles grow. The options market makers are trapped in a position they never expected to face. When they sold those $90 and $100 calls months ago, they were essentially betting that silver would never reach those levels. They collected premium and moved on, assuming the trades would expire worthless. But now they're staring at potential losses that could dwarf their entire annual profits from options market making. The These market makers operate with sophisticated risk management systems, but those systems are designed for normal market conditions. They assume that correlations will hold, that volatility will mean revert, that liquidity will be available when needed. But gamma squeezes break all those assumptions. They create feedback loops that overwhelm traditional risk controls. When the computers start buying to hedge gamma exposure, they don't care about fundamental value or market sentiment. They just execute the mathematical requirements of their positions. The silver mining industry is watching this derivatives drama unfold with a mixture of excitement and terror. Higher prices should be good for miners, but gamma-driven volatility can be destructive for their business models. Mining companies need stable, predictable prices to plan long-term investments. When prices become mechanically driven by options flows, it creates an environment where fundamental analysis becomes irrelevant. Some mining executives are privately worried that a gamma squeeze could actually harm the industry long-term. If silver spikes to $150 or $200 due to derivatives manipulation, it could trigger a massive increase in mining investment. New projects would come online just as the gamma squeeze exhausts itself, potentially creating oversupply and price collapse. It's the boom and bust cycle on steroids. But there's another layer to this gamma threat that most people don't understand. The silver options market isn't just about speculation. It's increasingly being used by industrial companies to hedge their input costs. Solar manufacturers, electronics firms, and automotive suppliers are buying call options as insurance against rising silver prices. This industrial hedging demand is adding to the gamma exposure building in the system. When industrial companies buy call options, they're not trying to make a profit on silver prices. They're trying to protect their profit margins from input cost inflation, but their hedging activity contributes to the same gamma dynamics that speculative traders create. The market doesn't distinguish between hedging demand and speculative demand. All call buying creates gamma exposure that market makers must hedge. The silver lease market is showing signs of extreme stress as this gamma setup intensifies. Silver leasing is how market makers and bullion banks manage their physical inventory. They borrow silver from large holders, sell it to meet immediate demand, and promise to return it later. But lease rates have spiked to levels not seen since the crisis of 2008. This suggests that physical silver is becoming increasingly difficult to source. When lease rates spike, it means the physical market is tightening faster than the paper market is pricing. It's a warning signal that the derivatives tail is starting to wag the physical dog. If market makers can't source physical silver to hedge their options positions, they might be forced to cash settle their obligations. But cash settlement during a gamma squeeze could trigger legal challenges and regulatory intervention. The regulatory environment is another wild card in this gamma equation. The Commodity Futures Trading Commission has been monitoring the silver market closely since the Reddit-driven squeeze attempt in 2021. They have the authority to impose position limits, raise margin requirements, or even halt trading if they determine that market manipulation is occurring. But gamma squeezes exist in a gray area of market mechanics that's difficult to regulate. Position limits might not stop a gamma squeeze because options positions are often held by different entities than futures positions. A hedge fund might buy call options while a market maker hedges with futures. The regulatory framework wasn't designed to handle the complex web of relationships that create gamma exposure. By the time regulators understand what's happening, the squeeze might already be over. Exchange-traded funds are amplifying the gamma dynamics in ways their creators never intended. When options activity drives buying in SLV or other silver ETFs, those funds must purchase physical silver to back their shares. But ETF creation and redemption is a slow process compared to options trading. This timing mismatch can create temporary supply shortages that feed back into higher prices and more gamma exposure. The international dimension of silver trading adds another layer of complexity to the gamma threat. Silver trades around the clock on exchanges in London, New York, Shanghai, and Tokyo. Options positions taken in one time zone create hedging requirements that must be met in other markets. This global interconnection means that a gamma squeeze starting in Asian markets could cascade through European and American trading sessions. Currency fluctuations are making the gamma setup even more volatile. Silver is priced in dollars, but it's consumed globally. When the dollar weakens against other major currencies, silver becomes cheaper for foreign buyers, increasing demand pressure. This currency-driven demand can trigger gamma hedging flows that have nothing to do with fundamental silver supply and demand. The cryptocurrency market's influence on precious metals is creating unexpected gamma correlations. Many crypto traders view silver as digital gold's physical cousin. When Bitcoin and Ethereum experience volatility, some of that speculative energy flows into precious metals options. This cross-asset correlation is creating gamma exposure in silver from sources that traditional analysis doesn't capture. High-frequency trading algorithms are adding another layer of mechanical buying pressure to the gamma equation. These algorithms monitor options flows and automatically adjust their positions based on gamma exposure calculations. When they detect building gamma pressure, they start buying ahead of the expected market maker hedging. This algorithmic front-running can accelerate gamma squeezes beyond what manual traders could achieve. Achieve. The psychology of fear is starting to take hold among the institutional silver shorts. These aren't retail traders betting their lunch money on meme stocks. These are sophisticated financial institutions with risk management departments, compliance officers, and board oversight. But sophistication doesn't protect you from mathematics. When gamma exposure reaches critical mass, even the smartest money in the room becomes a passenger on a runaway train. What makes this particularly terrifying for the shorts is the reflexive nature of their predicament. Every attempt to manage their risk by buying silver to hedge their options positions drives the price higher. The higher the price goes, the more options move into the money, creating even more gamma exposure that requires even more hedging. It's like trying to put out a fire with gasoline. Each bucket you throw makes the flames grow bigger. The physical silver market is showing cracks that suggest we're approaching a breaking point. Coin dealers are reporting allocation delays stretching into months. Industrial users are paying premiums that would have been unthinkable just quarters ago. The Shanghai Gold Exchange is seeing unprecedented demand for immediate delivery. These aren't normal market conditions. These are the warning signs of a system under extreme stress. Market makers are quietly reaching out to their prime brokers, discussing contingency plans for extreme scenarios. What happens if silver gaps up $20 overnight? What happens if options expire massively in the money and require physical delivery? What happens if the correlation between paper silver and physical silver completely breaks down? These conversations are happening in boardrooms across Wall Street, and the answers are keeping risk managers awake at night. The gamma squeeze building in silver isn't just a technical phenomenon. It's a wealth transfer mechanism that could reshape the precious metals landscape forever. When forced liquidation meets inelastic supply, fortunes are made and lost in minutes, not months. The question isn't whether this gamma bomb will explode. The question is when the fuse reaches the powder keg, and who will be standing in the blast radius when it does. So here we stand at $80, watching the most dangerous setup in precious metals history unfold in real time. The gamma bomb isn't a theory anymore. It's a loaded weapon with the safety off, sitting in the hands of market makers who never wanted to hold it. Every dollar higher that silver climbs brings us closer to the detonation point where mathematics overwhelms human decision-making. The establishment told you this was impossible. They said silver would never break 50, never break 60, never break 80. They were wrong every single time, and they're wrong now when they tell you this is the top. What you're witnessing isn't just a bull market. It's the systematic destruction of a derivative structure that was never designed to handle this level of physical scarcity, combined with explosive options demand. The next few weeks will determine whether silver becomes the greatest wealth transfer opportunity of our generation, or whether the regulators step in to break the machine before it destroys their carefully constructed casino. Either way, the game has changed forever. The paper price discovery mechanism that has controlled silver for decades is fracturing under the weight of its own contradictions. $80 was just the beginning. When this gamma squeeze finally triggers, when the forced buying accelerates beyond human control, you'll look back at today's price and realize you were watching history in the making. The silver market will never be the same. The only question left is whether you'll be holding the metal when the explosion happens, or whether you'll be watching from the sidelines, wondering what could have been.